Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Monday. It is May the 15th. And today we are going to talk a little bit about Devon. I have not done a very deep dive on Devon, but I have been collecting some information on Devon. And one of the things that I thought I might need to do before I actually become as bold as to say this is a buy is spend a little bit of time reviewing the 8 and 10K filings and then decide. But in the meantime, there's a lot of really good information about Devon in the marketplace. So I'm going to share some of the information with you. I also want to talk a little bit about discounted cash flow. A number of people, including myself, reference discounted cash flow or DCF from time to time. I want to talk a little bit about that when we'll look at Devon stock and a little bit of the fundamentals just to close it out. And then you can let me know what you think in the comments. So a couple of headlines. This is Motley Fool saying Devon down 40%. Devon Energy itself thinks its stock is a screaming bargain with a focus on its dividend. Many investors are overlooking Devon's share repurchase program. The company believes its stock is trading at a cheap price. Just a very quick comment on the concept of stock buybacks. Many times in the past, including during my time that I spent as an insider with a publicly traded company, you have this bit of a dichotomy in terms of doing share buybacks, because on one hand, you can say, I'm doing share buybacks because my stock is undervalued. It's ridiculously cheap. It's a screaming buy, and therefore I'm going to buy my own stock. On the other hand, investors might look at this and say, why are you buying your own stock? Do you not have any strategic plan or other areas where you could possibly invest your cash that will generate a greater return even than your own stock in terms of where it's trading right now? But anyway, Devon Energy thinks its stock is a screaming buy or screaming bargain, says the Motley Fool. Now, why would they say that? So there are a couple of reasons why. I'll show you in a minute. So Devon is currently offering a fixed plus variable rate dividend. It's a unique strategy. It's in fact the only company in the oil and gas consumables field that pays a fixed plus variable dividend. And what it's doing is it's paying a fixed base dividend that it aims to increase on a steady basis, but at the same time, it pays out about 50% of its post-base dividend, FCS's free cash flow, via variable dividends. Now, of course, these dividends surged or soared with the high oil prices of 2022, and the dividend, the actual payout, got close to 10%, which is obviously an incredibly good yield. But it's been declining over the last couple of quarters because of the energy price pullbacks. The CEO, Rick Moncrief, says fixed plus variable allows Devon to offer one of the highest yields in the entire S&P 500, so not just the consumable fuels industry. However, Devon is also repurchasing shares with a portion of that free cash flow, and the total cash payout annualized rate was 12%. So can you put your money where your mouth is, Mr. CEO? Yes, he can. So we're looking here at a few buys. I just highlighted one of them for you. These were a few insider transactions. They were buys at a price of around $60 or so. So if the insiders are comfortable buying the stock at $60, then you and I should probably think it's a reasonably good deal at $50 or thereabouts. Here we're looking at informative buys and sells. And the reason why we look at it informative only is because the insider activity sometimes relates to stock options, restricted share units, restricted share rewards, performance share units, and a whole variety of other things that trigger automatically. An informative buy means that the insider is actually using his or her own cash to make a buy or otherwise selling the stock. So Richard Moncrief, the president and CEO, has done quite a number of buys in the past few months. This is this year, so let's ignore this $830,000 that he purchased on the common market 8 months ago, because that was last year. But in this year alone, Rick has purchased $500,000 and another more than $500,000, more than $1 million worth of Devon stock as an informative buy on the open market. So the president and CEO is definitely buying. So is Clay Gaspar, who's the executive vice president and chief operating officer. He dumped $1 million on the stock a couple of months ago, also at around $60. So a couple of people have been buying. There is a snapshot here of the annualized or yield. This is obviously it dates back to the trailing 12 months, 6 times higher than the entire S&P 500 yield. Now, that's a little bit deceptive because some of the companies in the S&P 500 don't pay a dividend at all. Of course, there's a share buyback portion, which is this little gray block here on top of the actual dividend yield. So the dividends yielded for last year, 2022, approximately 8%. And the share buyback popped that dividend to just over 10%, organically funded with free cash flow. Capitalizing on the opportunity, back to Motley Fool. A couple of things here. He says, they say, we continue to see attractive value in repurchasing our shares. So I talked about that in a minute. And we believe we are trading a significant discount to our intrinsic value. Now, that's, of course, quite debatable. And one of the groups of people who kind of spreadsheet things to death are analysts who do the discounted cash flow in an Excel spreadsheet. We can talk more about that in a minute, and I'll promise you I'll go as quick as I can over the DCF modeling. To capitalize, Devon says they have advanced our buyback program by repurchasing 692 million dollars worth of shares year to date. And at the bottom, you can see the board of directors have approved upsizing the capacity of the repurchase program by 50% to $3 billion. I mentioned that briefly in passing the other day. Oxy has a $3 billion buyback program, but Oxy is a $60 billion company, more or less. And Devon has a $3 billion share buyback program, and Devon is a $30 billion company. So it's actually literally 2 times the size of Occidental Petroleum. What is DCF? So DCF is discounted cash flow. And basically what you're doing is you're creating a valuation to estimate the value of an investment based on its expected future cash flows, right? So the DCF analysis attempts to figure out the value of an investment today based on projections of how much money it'll generate in the future. Now, the wonderful thing about the DCF is that it's actually a great tool, and people have been using it for many, many years. The disadvantage of the DCF is that it really is a very complicated spreadsheet. And if you make many, many assumptions and you plug in some numbers into a spreadsheet, whenever you change one number, sometimes you change the entire spreadsheet results and format of the spreadsheet. If you have time and you would like to look at some of these, there's a website you can go to. It's called Omni Calculator. You can actually go there. It's called omnicalculator.com. Easy to find. So remember Omni Calculator, and you can go to .com. And there's a whole variety. I mean, you can use Omni Calculators to calculate everything from your lean body mass to your body mass index to discounted cash flow. So what you do is you go to omnicalculator.com/finance, and you get a whole, you get pages and pages of different calculators that you can use if you want to play with the discounted cash flow. Maybe there's one of the stocks in your portfolio you'd like to apply a discounted cash flow calculation to, just to see what its intrinsic value is and what its worth is based on a DCF. Now, here's the problem with DCF. So this is just one screenshot from a spreadsheet, right? And I mentioned the assumptions here briefly, but there's so many things that you have to do. So if you say the income growth rate, and I know it's really small here on the left, but if you say the income growth rate is 20% and it turns out being 22% or 18%, it changes all the numbers on the entire spreadsheet. To start with, though, you need to first decide, are you going to base your discounted cash flow on earnings per share or free cash flow? Because those two things are different too, and they're going to come up with a different result. So I like this little header here, the DCF model, complete guide to a historical relic, right? So there are people who still spreadsheet things to death. At the end of the day, if the company seems good, then you need to possibly make a decision as to whether you want to invest or not, but only you can do that based on your personal investment criteria. Another website you can visit, valueinvesting.io, and I just want to show you how ridiculously absurd sometimes the discounted cash flow valuation becomes. So what we're looking at here from valueinvesting.io is a Devon discounted cash flow valuation with a growth exit of 5 years, right? So what they're saying is the discounted cash flow value of Devon Energy Corporation is $90. With the latest price stock at about, let's call it $50, the upside of Devon is almost 90%. So 90% upside. And then you have WACC, which is the weighted average cost of capital divided by the discounted rate, right? So the minute you start using numbers, using historical numbers, you're assuming that those historical numbers are going to be valid going forward. And of course, any changes it's kind of like a golfer. If you think of a golfer teeing up a shot and taking out the driver, if they just like a quarter inch off target, when the head of the club makes contact with the ball, you might find yourself in the fairway next to the one you want to be, depending on how far you hit the ball. Anyway, the current price is about $50 and the fair price is around $90, says valueinvesting.io. Same with value investing. I'm just showing you some of the things here. I'm going to kind of breeze through this. I'm not going to spend too much time on it. Revenue growth. So what we're doing here is we're looking forward based on 2022 and then projecting ahead. Now, most of the projections are sort of reasonably, on one hand, you could almost say conservative, but fairly realistic. I mean, they're not going crazy here, right? So they're saying in 2022, the revenue is 19 billion, and then 23, 24, 25, etc. They're actually forecasting revenue, which you could argue is even slightly conservative, at around 16, 17 billion dollars. Cost of goods sold, obviously another variable you can't really predict. But what they've done there is they've also downsized that based on the fact that the revenue is slightly smaller. And then right at the bottom, net profit 31%. They just continue 31% right through the entire model, basically assuming that Devon can generate 31% on an annualized basis every single year for the next 5 years. Now, Devon might generate 40. They might also come in at 25. Who knows? So it's tough to make these predictions. And I'm sharing this with you because very often people think, people ask me, what do you think is a fair price for whatever? In this case, Devon. I don't know. All I know is that at around $50, Devon seems to be, at the very least, fairly priced, right? So not excessively cheap, not ridiculously cheap, not a screaming buy, but it certainly seems to be a fair price, right? So same here, Capex, the expenditure plan. So of revenue, 25%, they just flatline it all the way through for 5 years. And then Capex as a percentage of revenue bounces up and down a little bit because revenue changes. So anytime you're going to use that fraction, you're going to have some variations in the working model. Continuing with valueinvesting.io, changing working capital forecast. Once again, trade receivables, tough to predict, right? There's no way that you can predict the economic climate for the rest of this year, let alone for the next 5 years. But at the least, in their defense, the estimates that they've come up with seem to be reasonably or fairly conservative. Trade payables, same thing. Inventory. So they actually dropped the number here from 201 down to 58, etc. So reasonably conservative. Not too much wrong with it. They still come up with the value of $90 per share. I think this is the last one, enterprise to equity value calculation. Same thing here. They're looking at the terminal value, the weighted average cost of capital divided by the discounted rate. FCS is free cash flow. EBITDA is the earnings before interest, taxes, depreciation, and amortization. You don't know if they're going to have a write-down or something like that. That affects the depreciation, amortization, etc. You don't know if the taxes are going to change over the next 5 years. If it's up to the Biden administration, Devon would be paying more tax, so maybe this number is wrong. I don't know. There are too many variables in a discounted cash flow model to use it as a predictive analysis to say this is what the share price actually should be. So how about this? I'm still on valueinvesting.io, but now I'm looking at the Peter Lynch formula. Of course, he's the guy who wrote the famous book, One Up on Wall Street, and Peter Lynch is one of the greatest investors of my generation for sure. Peter Lynch's model is a little bit more simple. He's basically saying Devon fair value equals earning growth rates multiplied by trailing 12 months EPS, earnings per share, right? So a really simple model. Earnings growth rate, we can kind of see what they did in the past. TTM is trailing 12 months and EPS is earning per share. So it's 25 earnings growth rate multiplied by 9.35 gives you 233.83. $233.83. That's the fair value of the stock. So it's like, damn, if Peter Lynch was buying Devon today at $50, is he predicting it's going to 233? Possibly. Over what period? Maybe 5 years, because that's the 5-year average we're looking for. Peter Lynch also famously said, behind every stock is a company. You better find out what it's doing, and that is what we are doing right now, right? Still with valueinvesting.com, I'm wrapping it up here with their discounted cash flow model, the projection period, and the terminal value of the share minus the current debt, equity value divided by the outstanding shares, $90 per share. Over to Morningside, I have a number of analysts rating the stock here. I've got 21, in fact. 13 are saying hold it at the current price. 10 say it's going to outperform, and 8 say it's a buy. Devon says it's a screaming buy, right? You can tell me what you think in the comments. Staying with Morningside, I'm here with Dave Meets, and Dave is saying that the bulls say we can expect above average well performance and peer-leading supply costs. The shareholder-friendly capital allocation opens the door to substantial returns. They're capping the growth at 5% annually, and by doing so, Devon avoids the risk of overspending during up cycles, a common fault of upstream firms, which is what Devon is. And the bears say, still with David Meats, so it's basically saying the bulls say and the bears say, after incorporating costs sunk on leasehold acquisitions, exploration, etc., Devon's capital base inflates to a level that puts excess returns on capital out of reach. And the profitability of Devon's Permian assets is unmatched elsewhere in its portfolio, basically implying that Devon's crown jewel is their asset in the Permian Basin and not so much everything else. This is CFRA. Stuart Glickman has a 4-star rating on it. He says it's a buy with a 12-month stock price of $61. This 12-month target price of $61 is probably more fair and realistic to me than the $90 that I just showed you from valueinvesting.io. Trailing 12-month dividend was $5.06. So if you're at a $60 stock with a $5 dividend, assuming they can get there again based on their fixed plus variable dividend, probably running at around 8.5%. That ain't bad. So what does Devon look like today? So I actually took the screenshot over the weekend, so it looks a little bit different today. I think it was a little bit green, but not much anyway. So you can buy Devon for around $50. It's trading at the left side on its 52-week range. It's super cheap. It's hard to believe that just a few months ago, it was almost $80. Kind of looks like Occidental Petroleum, right? So just a couple of months ago, Occidental Petroleum was $77, and now it's trading at like $58, right? So the energy stocks have all pulled back in tandem. So it's not as if one stock is necessarily worse than the others. There are a number of compelling reasons why Devon is interesting. One of them is the fact that it is generating good earnings per share. Its PE ratio, its price earnings ratio, is very low at 5. 5 is a super low PE ratio, showing that the stock is arguably cheap or undervalued, or as Devon says, a screaming buy. Nice annual dividend. I'm not sure if it's going to be $4.51, which was or would be yielding 9.5% on the $47 stock. But if it remains at $4.50 and the stock goes to $60, then obviously this drops down to like 8% or so. And conversely, if the stock drops down to $35 and it's paying $4.50 per share on an annualized dividend yield, then that dividend shoots up to like 12% or whatever. 70% held by institutions. Not a lot of shorts on this one. I don't think anyone would be brave enough to short Devon when it's trading at $47.50 or thereabouts. TipRanks has Devon on an outperformance at 10. I showed you the insider activity. They bought a lot of shares. The analysts have it as a moderate buy with a target price of 66, right? So I just showed you CFRA was at 61, and valueinvesting.io was at 90 in terms of their discounted cash flow model. And the analysts on TipRanks are saying 66. How many analysts? We got 19 sell-side analysts here offering us a price target. The low is 49, sort of more or less where it is right now. And the high is 87, and the sort of average on that is $66 per share, which would not be too bad if you get into this stock right now, which is also one of the reasons why I told you in the last video that I'm much more keen on Devon than what I am, for instance, on Occidental Petroleum. I am about to wrap it up here. Devon has a debt-to-capital ratio of 37%. It's in line. When I was talking about Occidental the other day, I mentioned that they also have a debt-to-capital ratio of around, high 30s, almost 40%, despite the fact that they've paid off a lot of debt. This is kind of average in terms of the oil, gas, and consumable fuel industry norm. But there's a huge difference here between Occidental and Devon Energy, right? So Devon, despite the fact that their debt is about the same as Oxy based on a ratio or percentage basis, Devon actually has a quick ratio greater than 1 and an interest coverage ratio of 17, right? So the reason why I'm highlighting that for you is because when I looked at Occidental Petroleum the other day, just a few days ago, I made a video on Occidental Petroleum, and I shared with you that Occidental Petroleum's quick ratio was 0.89, right, from memory. So you cannot have a quick ratio below 1, because that means you don't have enough cash on hand to pay your current liabilities that are due within the next 30 days or so. Devon's, on the other hand, is greater than 1, which means they are not like Oxy flying too close to the sun, and they have enough cash in the bank to pay their bills, which is an important thing. Now, of course, when you're running a company that's generating, $1 billion or whatever per day, or hundreds of millions of dollars of revenue per day, you can change those numbers very quickly. But at the end of the day, those ratios are ratios investors should be looking at and should pay attention to determine whether the company warrants them putting their money into that company as an investment. The interest coverage ratio for the most recent quarter for Devon, 17. Oxy didn't have an interest coverage ratio that I could share with you. The only thing that they had was a quick ratio of 0.89, which is just horrible. And Devon sort of in line with the industry here, 1.03 compared to 1.02, so about the same. And the interest coverage ratio for Devon is significantly above the industry average, almost 40% above the industry average. So guys, that's kind of a wrap on Devon Energy. I have mentioned a couple of times that I like it. I did originally open a position in Devon when Devon was trading at around $58 or so. I think that was my first buy, $57, $58. I've added some since then. And when I made that first buy, I actually mentioned it briefly in one of my videos. And I said, I bought some Devon today at, $58. I would have preferred to buy it for $50, but hey, what can you do, So I'm not buying it for today. I'm not day trading. I'm not swing trading. I'm just buying it and holding it. My average hold on a stock, as I've mentioned several times before, is about 3 to 5 years. I expect Devon, which is currently at $50, to certainly edge up to $60 or thereabout, maybe within the next 12 months or so. And at the same time, of course, I'm collecting that dividend. And as you know by now, I reinvest my dividends because I don't need to draw the cash. So every time as Devon is trading at whatever the stock price is trading at, when I receive that dividend, I just buy some more stock and add it to my little bucket of Devon stocks. That's my view on Devon. I'm interested to know what you think. Do you think it's a buy or not? Are you even interested in Devon at all? Or is the energy sector even interesting as a whole? Or have we, sort of run the gamut on that one and we're just bag holders now in terms of energy stocks? And let me know what you think in the comments. I look forward to interacting with you. Bye-bye.